Hey, what's up, guys? I'm Hard Money Joe. I've been in real estate full-time since 2017, and in the last year or so, I've just been lending out our capital to other real estate investors, and I want to quickly cover 5 of the main reasons within that period of time that we've seen real estate investors fail. All right, the first one is that you didn't buy the right deal. Right? You've just started investing. You're really eager to get into the property, but you didn't purchase the right deal. And that doesn't always mean just that the numbers were bad. Obviously, that's, the main one. But by buying the right deal, really what I mean is, you'll come in, you'll buy a really valuable property, a high ARV, or maybe even just a huge rehab. You're not experienced enough to know how to navigate a $100,000 flip. So what I would suggest when you're first starting out in real estate flipping is to buy more of a cookie cutter deal, something that doesn't necessarily need an absolutely enormous rehab, something that has plenty of comps and again is just kind of cookie cutter, maybe a 3-2 brick house and a lot and block subdivision that has plenty of comparables for it. So it just gives you a little bit of extra confidence. And those other deals, those kind of quirky deals where you can still have the potential to make a lot of money, they'll come later on as you get experience. But yeah, definitely one of the first ones is you didn't buy the right deal. Now, obviously, the pricing, the purchase price you get it at is a big factor, or making sure that you evaluate the after repair value, what it's going to sell for correctly. Those are also huge factors. The second the second biggest issue we see when real estate investors fail, and this one's probably a given, is you don't choose the right contractor. Contractors can make or break a deal, right? Everyone starts off full of promise, but what I would suggest is always work on a referral basis, especially when you're choosing your first contractor for your first deal. Go out there and meet some other investors that they've done work with and see what their experience was like, right? If they don't have those previous relationships to give you, those are some red flags that you want to avoid. Go and walk some properties that they're currently doing, or, take a look at some listings that have sold from those investors. The reason they fail with contractors generally because the contractor underbid a job to try to get that work, right? They come in and they'll bid $60,000 knowing full well that $60,000 might not take, right? It might end up being $70,000, $80,000, $90,000. Well, if you're not highly liquid and you didn't account for that additional budget, that can really, hurt your deal. And if you don't have that liquidity, that can sink you pretty quickly, right? Now you're scrambling around to, pay the additional funding for the contractors to complete the work. They're just sitting there. They won't do the work until, they get paid the extra amount. So also make sure in your contract that anything to do related to change orders or increasing of pricing is all there on paper, right? It might be a little bit of an uncomfortable conversation when you start, but you want to have that ironed out. You want to have everything on paper, and you want to know what happens in the event that the prices go up. That they're not going to throw you any curveballs that they were already expecting. Now, I would always say put a contingency when you're evaluating your rehab. You're always going to put 10 to 20% in there just for oh crap money. But yeah, one of the most important things is making sure you have the right contractor, making sure you vibe with them and your character traits align with their character traits. If you have a good contractor, they're going to sell through the job. Any issues you're going to have, and you will have issues, you're going to be able to navigate those pretty easily with that contractor if you guys have a good relationship, and also if you outlined everything in every scenario from the beginning of the job. The third most common way we see investors fail is getting over-leveraged. And by over-leveraged, that doesn't necessarily mean you have, just have too many deals. They could all be really good deals and numbers worked, but you spread yourself too thin on your liquidity. What we see a lot is an investor that make all the right decisions. They come in, they flip a property, and they make a good amount of money, right? They walk away with $60,000, $70,000 profit, but then they get, I wouldn't say overconfident, but they don't spend enough time working out how quickly your capital can be stuck in these deals, and they get over leveraged, right? They go in, they buy 2, 3, 4 flips. They're waiting on draws. They've got the closing fees for when they close their deals. Now all of a sudden, there are 2 or 3 deals. They've got $20,000 into a deal or $30,000 into a deal. but you multiply that by 2, 3, 4 deals, well, that can quickly eat up all your liquid reserves. And then you're still having to make the debt coverage because the properties are vacant. And then that's when it starts to get stressful, right? So I would always say when you're getting into a deal, one of the main focuses that you're looking for is how to avoid the stress of that deal. And investors can get stressed with very good deals that are going to be excellent once they sell, but because you didn't keep enough liquidity and you over leveraged, or you're dealing with stressful situations from the contractors, that can get you to not want to stay in the business, right? By having that stress. So when I would evaluate a deal, I would look at what is my total out of pocket, right? So you can use that on our calculator at sparklending.com. You can evaluate everything that's going to cost you to be out of pocket for that deal. But you want to evaluate not just the leverage, but also the timeline of that deal. How long is that deal going to take you? Generally speaking, if it's a much bigger rehab, it's going to be a much longer time frame. Something that we would kind of do back in the day is we would estimate about $10,000 per week. So if our rehab bid was a $60,000 rehab, we would estimate it's going to take us about 6 weeks. $80,000 would be 8 weeks, and so forth and so forth. So you really got to tie all those in if you're doing multiple properties, right? If you're buying 3 properties that are all $100,000 rehabs, well, you don't have that velocity of capital, right? You might have a couple of rehabs which are a much more minor cosmetic fix, which have $10,000, $20,000 of work. Well, you can recycle back and redeploy that capital and put that capital back to use, rather than having 3 deals with huge rehabs. So just little pointers like that can really help with the over leverage and making sure you don't get yourself in that position. The third most common reason we see investors fail is because they get emotionally tied to a property, right? And that is the last thing that you want to do. It's very difficult to get in there, right? You got your wife, she walks it with you. You start talking about paint colors and granite and flooring, and you're going to your local floor and decor store, and you're choosing the very best tile. Well, you really got to take this as a numbers game and make sure that you're evaluating just what you have to put into that property and what you need to get that property done, right? These are not houses that you're going to go live in generally, right? So you want to be a pro at looking at what the market is telling you, what the data available is telling you, and you want to match that, right? At the end of the day, you're operating this as a business. You want to have as good of a bottom line as you possibly can. And the way that you're really going to do that is to not get emotionally tied to that property. Don't go in there and say, well, I would love French doors here in this room, or I would personally love a deck, but it's a $150,000 rental property and it just doesn't call for that. So that's a huge one and something a lot of people don't miss. You really have to kind of force your mind not to get emotionally attached to them. It's just human nature. The last one I would say, so we have you didn't buy the deal correctly. You didn't choose the right contractor, you have over leveraging, you have getting emotional. And the fifth one I would say why real estate investors fail is because they don't become real estate investors, right? We all have very different personality traits, and one of those is to be over analytical. So we get a ton of potential borrowers coming to us, and they run deal after deal after deal after deal. They spend so much time evaluating these deals. But there's always going to be something wrong with the property, right? There's always going to be, a question mark. Is the days on market not good enough? Is the layout not good enough? Is the school district not good enough, right? Well, you are at some point going to have to make a calculated decision, but you're going to have to make a decision and you're going to have to take action. We see a ton of people not taking action, and then they get burned out by that analysis paralysis. So real estate can be, and flipping houses in particular, and holding rental properties can be very lucrative. That's why there's so much content on it. That's why so many people in every walk of life you hear start saying, I want to start flipping houses. Well, because they know that there can be a lot of money in it. And I would always say that the first deal that you get into is going to make or break your career in real estate, right? If you spend a year of your time and you're incredibly stressed and you're visiting that property 2 or 3 times a week, you're dealing with contractor issues, you're dealing with, city permits, you're dealing with, every nuance that can come with flipping a house, for that 12 months and then you eventually sell it and you walk away and you make $5,000, you're going to look back on that ordeal and you're going to say, this isn't worth it. It's not worth my time. And trust me, that happens a lot. Or the other way that it can play out is you made a calculated decision, you were firm on your numbers, you had a good lender that was honest to you, you had a very good contractor that was very accurate when they initially started giving their bids. Your lender will tell you, I think this is a good deal, I don't think it's a good deal. I built the last video I did was on the team members. One of the most essential parts of having a good team around you is to have extra set of eyes on each deal so they can say, hey, I think this is a really solid deal and I would go for it. But if you have those pieces in place, and it's not difficult, right? You just need to make sure it's there. Then these 5 factors won't affect you. You'll get through that rehab. You'll get through that first flip. You'll make a considerable amount of money, like we've seen investors time and time again, and you'll see the potential and you'll be hooked, right? And then you'll really start trying to develop and scale this and make each step more automated and make the final process even more profitable. So, yeah, those are the 5 major reasons we see real estate investors fail. If you guys can think of any more, would love them in the comments below. Again, my name is Hard Money Joe. If you're new to the channel, really happy to have you involved. We give as many real estate tips as possible. All the content is raw and organic. There's no fluff. Not trying to sell you anything. Just kind of talking about our years of experience. But we'd really like it if you could like and subscribe. We do some great interviews with some actual real life investors, so you get to see a behind the scenes of what goes into being a real estate investor, right? The nitty gritty, not just the HGTV fluff that shows it before and after. So you're in the right place if you're thinking about getting into house flipping, or even if you're already house flipping. Thanks, guys.